My name is Neela, and today I'm going to speak a little about the financial statements and the accounting equation. First off, I want to start with the accounting equation. So the accounting equation, as we all know, is assets, which is equal to liabilities plus equity. And the asset section, it's divided into current assets and fixed assets. The current assets, the cash and other resources which the business is expected to be used within 1 year of the operating cycle of the business, whichever is longer. And the four major or most common types of current assets would be short-term investments, cash, accounts receivable, and short-term notes. There's also accounts receivable, goods for sale, prepaid expenses. Then we go into the fixed assets. Now the fixed assets are divided into different sections. We have long-term investments, we have plant assets, intangible assets. Now the buildings, land, machinery, these are all the most common of the fixed assets. Long-term investments will include like notes receivable, investment in stocks, bonds which are long-terms, and the plant assets, normally they're tangible assets which are long-lived and they're used to produce or sell goods and services. Of course, these are the machinery and equipment. We go into the liability section now. Now for the liabilities, it's divided into current and long-term liabilities. The current liabilities are obligations due to be paid or settled within 1 year of the accounting cycle. Now, we all know that in any business, you would purchase stuff on credit, and not all the transactions are done on a cash basis. So this is what the current liabilities include, and they are usually accounts payable or notes payable. The notes payable can be a short-term note payable to a bank or to another company which you have made an agreement with to pay within a certain period of time. There's also wages payable, taxes payable, interest payable, and unearned revenues. Now again, we must remember that all these are due to be taken care of within the accounting cycle. We go into long-term liabilities, which are obligations that are not due within 1 year, so which means there's a longer period of time in which to pay these. They're notes payable again, and these notes payable can be from the bank or another investment company which agreement is made, and these we have like 2, 3, sometimes up to 20 years. There's also mortgage payable for, let's say, a building that we might have purchased or machinery that's on payment terms. There's bonds payable, and of course we all know about bonds. Bonds payable, we have like stipulated terms, can be 5, 10, 15, 20 years with a certain percentage to be paid every year. And also there are lease obligations. So lease obligations would be you lease machinery on a long-term basis or equipment to be used for the business. And then we go into equity. Equity, of course, is the owner's claim on assets. And this is divided into two main subsections. Now, the common stock, which we know would be the capital of the net worth of the business. Then, so whatever the owner would have put into the business, this, the value of it, it's what's called the equity. And then, of course, returned earnings. And the returned earnings would be for a company which would have been started or established already. And now that we've spoken about the accounting equation, I would like to speak a little about the financial statements. Now, as we all know, in accounting, there are 4 financial statements. The financial statements, and the most common, is the balance sheet. Then we get to statement of cash flows. There's also the income statement and the statement of the stockholders' equity. The income statement describes a company's revenues and expenses along with the resulting net income and loss over a period of time. The balance sheet describes a company's financial position at a given point in time. The statement of cash flow is about finding out where the liquidity of the business is and how much working capital the business has. And of course, the equity, the statement of the stockholders' equity, is the worth of the stakeholders or the shareholders at a given point in time. And now with me today, I have Mr. Edward Lee, who's a CPA, and he will explain a little more about what the balance sheet and other financial statements are and some of the things that are included in them.
Yes, hello. My name is Ed Lee. I'm a CPA since 1978. I have experience in large corporations. Back in the early 70s through 90, I worked for J.C. Penney's, Merrill Lynch, Dean Witter, primarily in the auditing area and also the tax area. For the last 20 years, I have a small accounting practice out here in Babylon, New York, primarily servicing small clients. I'm also a graduate of Brooklyn College in 1971. Neela asked me to basically just talk about the balance sheet. And, just basically just touch some of the overview of it. Balance sheet is also called a statement of financial conditions. It's a very valuable tool for a number of people. It can be used as a management tool. It can also be used for shareholders and potential investors, also creditors, stock analysts, and of course banks. So why is this tool so useful for everybody? Basically it's a snapshot of the financial condition of a company at a given point in time. And it contains numerous data. Obviously the first one, it summarizes your assets, liabilities, and equity. The assets are categorized as short-term or current, which gives us an overview of the cash position, cash equivalents, the various different types of investments, CDs, savings accounts, treasury bills, and then it goes into the inventory or the receivables. Actually, the receivables. You take a look at your receivables, you get a good idea of the amount of the receivables, the turnover of receivables, and we also have an inventory listed if there's any inventory. You can see the turnover for the inventory. Numerous ratios can be developed from this data. Then we go into the area of fixed assets, which would include anything from land, buildings, furniture, equipment, machinery. It all depends on the type of industry we're talking about. From there, we can go into the various notes, short-term loans receivable. We can look at the current liabilities, which will give us an idea of the current accounts payable, which would include anything from vendors, taxes payable, payroll, sales taxes. And, from there, you can look also at the loans that are on the books that we made to outsiders, short-term loans less than a year. Then we go into the long-term liabilities, which would be any mortgages that we owe, any notes payable, loans payable. And then at the bottom of the thing, it summarizes the equity, the shareholders' equity. It tells you basically how the capital is, the initial capital. And then it summarizes all the retained earnings, the history of the earnings of the company, or the losses. It also, has we could develop, the ratio showing us the price to earnings for public corporations, earnings per share. You can develop current ratios, as I mentioned before, inventory turnover. You can age your receivables. And basically, it tells you the footprint of the financial history of the company at that point in time. As I said before, it's a valuable tool for many people.
Okay, now we want to go into another one of the financial statements, which would be the statement of cash flows. We have also the income statement.
Well, our income statement, obviously, everybody's concerned on the current health of the company. The income statement will basically tell us how are we making money or losing money, over a certain period of time. It's usually income statements are usually on a monthly basis, a quarterly basis, and on an annual basis. If you're a public corporation, you have to do certain SEC filings, your 10Qs, your 10Ks. And this basically would match, our revenue, which most large companies are on the accrual basis, money coming in, and versus matching it against the expenses. And it's categorizes by industry, the type of revenues we receive, whether it's commissions or if it's sales of property or retail sales, and it matches that against the expenses incurred to generate this income, which we all know payroll taxes. Also, another is the cost of goods sold if you're in the manufacturing area. It can be done on a standard cost basis. A lot of the manufacturers, over the years, has developed their standard costs, and this is very valuable for management to look if there's any deviation from what they expect the cost of their goods should be. And then, you get into your overhead, you get into your rents, your taxes, and just your daily expenses that, you incur in order to generate your income. And as I said, it's generated, monthly, quarterly, and annually. And if you're a public corporations, you have certain SEC filings that you must adhere to, and the income statement definitely is one of them.
Okay, and then the statement of cash flow?
Cash flow. For cash flow, everybody's concerned about, really, it's a statement of working capital. Income is one part of it, and then you have to look at the other aspects for increasing your cash inflow, and your areas where the cash is outflowing. Cash is inflowing. You have to look at your receivables. Did you buy equipment? Did you buy new inventory? Did you buy? Did your notes increase? These are all sources of cash inflow, and then in addition to that, you have money going out. So obviously, when you look at the cash inflow compared to the cash outflow, that basically is your working capital or your current ratio, which is one of the most important ratios you would need to make sure that you are solvent and you have the ability to conduct your business that you intend to.
Okay, and then the last type of financial statement?
The last type would be the shareholders' equity, the changes in shareholders' equity. This here, basically accumulates, it summarizes everything from day one, the capital that's been invested in a corporation, and it starts off with your initial capital, and then you basically, you would add to it, or you would, basically you would add to it hopefully through your earnings, your retained earnings, or additional capital, that you might be required to raise, either from your current shareholders, or go out and find new sources of capital. And basically it's a summary of whether the company has been profitable or has it been losing money, which has occurred, and so it's basically you look at the history of the capital of the company, and the earnings, and the money coming in and the money going out.